but I'm talking about systemic weakness. So when you have a large sector of the financial industry, which shadow banking is in many countries, that isn't regulated, there is always the worry, the fear that any kind of systemic failure there could have a knock-on effect on the regulated sector. Almost a repeat of LTCM in 1998 when it was bailed out by the US Federal Reserve.
This is Liquidity Talks, a live stream and podcast series designed to share the latest trends and updates from the world of treasury, liquidity and risk. Join us as we power up the liquidity conversation.
Hello and welcome to our latest instalment of Liquidity Talks live stream and podcast. I'm Neville Roberts, CEO and founder of Planix, the market-leading fintech focused on real-time treasury, liquidity and risk. Now, our topic today is entitled How Shadowing Banking Impacts Liquidity Management. It's a very interesting topic for today. Welcome to our audience today as well. Good morning, afternoon and evening, wherever you may be. Anyone in the audience can ask a question as we run through this session. It runs for 30 minutes today. And if you do want to ask a question, just put us in the comments section. You'll see on the right-hand side of your screen. If you do ask a question, please let us know who you are and if you possibly can, your role, so we have some context. One other thing for the audience today, we've had a few audience members actually be part of our podcasts. So if you'd like to be part of the podcast in the future, just email Nick Appleby or Adam Pemberton, whose email you will see in the comments in a few seconds. Now, today, I'm joined by Liquidity Talks podcast legend, audience record holder and the holder of the most views for a single podcast. I'm, of course, talking about our guest speaker today, Professor Moorad Choudhry. So, Moorad, after that introduction, many of the audience will also know you from the past, but would you like to introduce yourself, tell us who you are and what you do?
Good afternoon, Mr. Roberts. Good afternoon, everybody. Thank you for the very kind introduction, Neville. It's very, very kind indeed. So, Moorad Choudhry, City of London experience the last 35 years, now currently a non-executive at a couple of UK FIs. So I'm sort of part-time these days. Experience probably half of my career in investment banking, wholesale banking, and the other half in treasury, front office, middle office treasury, and asset liability management. Of course, once one is on the board of the bank, then of course, in theory, one is looking at every aspect of the bank. I say in theory, in practice as well. But that's probably, I guess, my core area of experience in half of my career, treasury and ALM risk.
Perfect, got it. Now, we've been through this before, Moorad. I know you're a Wimbledon fan, and it's fair to say I've suffered my amount of pain from the 1988 FA Cup final many, many years ago, but it's still in the psyche.
Yes.
However, do you want to very quickly tell your Wimbledon story? So, because if people went on the last podcast.
Oh, well, which one? I Wimbledon fan, of course, naturally.
As short as possible.
I knew you were going to get me off there. 1988 was an amazing time. The Crazy Gang inspired many, simply to show that by punching above one's weight, it is possible occasionally to end up top, as Liverpool know. But AFC Wimbledon also going strength to strength. One of the bestest people I met in terms of coaching-wise, Neil Ardley and Neil Cox, when they were managing and coaching at AFC Wimbledon. Still doing very well in League Two now, obviously not in the Premiership. But hey, that's, one hopes eternal, right? One dreams eternal.
Indeed. Well, look, thank you very much for agreeing to come back on the podcast today. We had quite a lot of questions still over from the last one. So it's great to have you back, and let's try and cram as much in as we possibly can. We're going to give viewers the chance, as we did last time today, to win Moorad's book. It's called Anthology, Principles of Banking and Finance. If viewers want to get a chance to win this just opt in the comments section. Just type opt in. We know who you are. So we'll take that as you're in, and we'll make the draw after the event. I can say it's a marvelous read. I don't have one with me, but I know you do, Moorad. So if you just want to put it up.
You're very kind.
And then we can show you.
I like the fact that you said it's a marvelous read, but you don't have a copy. I like that. There we go.
I don't have a copy with me, and that's not. It's the size of a doorstep, but you're not going to use it as one. Okay. So
well, hopefully, yes. You're very kind. Thank you.
Right. No problem. So we'll be running that draw at the end of the podcast. Right. Impact of shadow banks on the industry, the good and the bad. Right. Question one, Moorad. Probably best to start off by describing what we mean And what are shadow banks and how they differ from traditional finance institutions?
It's shadow banking. It's actually quite a wide-ranging term. It encompasses quite different types of institutions. Shadow banking essentially refers to the industry of any market participant that undertakes banking type activities with third parties, but isn't actually a regulated banking institution. So that might include, for example, lending money to corporate or retail customers without having a deposit license, or indeed accepting deposits which don't come under a government guarantee deposit scheme, but the deposits are invested in some part of the markets. Or it might include payment services firms, firms that enable payments between wholesale institutions, corporate institutions, or firms that enable individuals to make payments. We think of a village football club using SumUp to accept payments through credit card, or a firm like Stripe that enables cross-border payments. So it's actually quite a ranging term. It encompasses very many different types of institutions, but what they all have in common is that they undertake one or more aspect of what banks also undertake, but they're not
Yeah.
regulated banking entities.
Got it. Perfect. Great level set. So now we understand that. It'd be good to understand, the good and the bad, positive, negative of the aspects that these institutions have on the financial industry. So let's start. Let's start with the good. What are the good aspects that these banks or these institutions bring to the industry?
And there's certainly more than one. These types of firms enable more choice. For example, I mentioned the village cricket club that might no longer take check payments, and their players, or they don't necessarily, when they pay the subs, don't necessarily have cash on them. So it enables small entities, individuals as well as corporates, to take credit card payments, for example. They enable cross-border transfers more efficiently, more instantly. They enable more choice for both corporates and retail individuals with respect to deposit and borrowing options. Think of mortgage providers who aren't banks, for example, residential mortgage providers. So the good is increased competition always improves the overall health of the market. This is a good thing. The increased choice is always better for consumers, and it helps to keep prices competitive. So there's certainly lots of pros associated with institutions that are in the shadow banking sphere because of the choice, the maintenance of competition, and the ease of transactions that some of them will offer to their customers.
Got it. And look, so I think it's fair to say there's been a proliferation of these finance institutions over the last 5-10 years. Certainly, the names, the brands I've seen around, there's a lot more than there used to be.
Yeah. Yeah. I mean, think about, if we go back 10, 15 years, the increasing incidence, the increasing accessibility of high-end technology, digital technology enables barriers of entry to be reduced. So it's easier to set up a fintech type, let's call them fintechs if you like, a fintech type firm now than it might have been, say 10 or 15 years ago, because the big technology is more accessible. Use of digital algorithms, if you like, makes reaching the marketplace more accessible. So yes, there's lower barriers to entry and there's increasing choice. Now, in terms of the cons, which I knew you were about to go on
Yeah.
to next, and I've just seen something in the chat about Visa and Mastercard. Now,
Yeah, I
Visa
was
and
going to ask you
Mastercard
that.
are very these are global, multinational institutions. In terms of cons, I wouldn't necessarily say con, but it's something that the industry as a whole and regulators need to keep an eye on, insofar as when firms that aren't regulated entities undertake commerce that may be exposing its customers to some sort of risk exposure, then the fact that they're outside of regulation means that there could be some aspects of systemic weakness that are going undetected or unmanaged. And I do mean systemic weakness. I don't mean an individual firm, much as the failure of an individual firm would be bad news for its customers or its stakeholders or shareholders. But I'm talking about systemic weakness. So when you have a large
Yeah.
sector of the financial industry, which shadow banking is in many countries, that isn't regulated, there is always the worry, the fear that any kind of systemic failure there could have a knock-on effect on the regulated sector. Almost a repeat
Yeah.
of LTCM in 1998 when it was bailed out by the US Federal Reserve, because they were concerned about knock-on impacts on the regulated sector. So that's probably the biggest con, if you like. I mean negative, I don't mean con. I meant downside of the shadow banking sector, because its size may have systemic knock-on effects on the regulated side of the financial sector.
And are they more susceptible to crises, market shocks, black swan events, I guess?
Well, that's That's the question, isn't it? Are they more susceptible? Now, the failure of some large banking institutions last year, and we don't need to name them, we all know who they are, shows that one can be regulated, indeed large size, and still fail. So I wouldn't necessarily say they are more susceptible. Certainly, you have failures in fintech or in shadow banking firms as much. They have exposures, and they will be at risk of downturns in the market, or negative market impact on them. They're at risk in the same way that regulated entities are. But I suppose in terms of being not individually more susceptible than a regulated institution, but possibly if there's a large scale failure in the unregulated side, the knock on effect may be harder to manage in the regulated
Yeah.
sector because it might be unforeseen or it wouldn't have been measured. Now, in that respect, where banking institutions are conducting business with shadow banking institutions, and many of them do, of course. Many of them have, in fact, subsidiaries in this space or dealing directly with them. Then, of course, it's up to them to manage that risk on a counterparty by counterparty basis because they know that their counterparties are in the unregulated sector. So this is something I would say that banking institutions need to be aware of. The main risk exposure, being aware, know your risk, and know the risk of know your counterparty risk, and indeed their counterparty's risk. One's got to be able to look through the immediate counterparty to see what your counterparty's exposure is to other parts of the industry. And that's a challenge for banks because one is dealing with institutions that aren't regulated.
Yeah, and look, we talk to banks all of the time, but many people in that industry and outside have told me that they believe when a crisis next happens or the next one, it's probably going to come from the shadow banking industry, not traditional banks. Do you think that's a fair view of the world, or
Well, I mean, it's a view. It may well
yeah,
have some substance. I wouldn't like to predict what the next market-wide stress event looks like. We wouldn't have known, although looking in hindsight, they may have left plenty of trail along the way. We probably wouldn't have guessed in
yeah,
2022 that Credit Suisse was going to become unviable in 2023. In 2019, we probably wouldn't have guessed that a number of reasonably large, although below the
yeah,
systemic size, reasonably large banking institutions in the US and the west coast of the US would become unviable. I personally wouldn't like to predict where the next stress event is going to come. But it is a common view that whatever it is, it might hit hardest or come first in the shadow banking sector. All I can say is, like with all good risk management practice, be stress test and scenario plan with as much creativity as possible because the next stress event will be one that we don't predict. In
yeah,
the same, we haven't predicted or foreseen. In the same way that no one predicted lockdown in March 2020,
yeah.
that came suddenly. I wouldn't like to predict where it's going to hit. It could easily hit in the regulated sector as well. But again, the worry is if it's in the unregulated sector, we may be less resilient in being able to respond to it and work through it because it's a part of our exposures that aren't being or possibly aren't being managed as in depth as the risks that are managed in the regulated sector are, if that makes sense, because they may
Yeah,
not
it
be
does.
in our sight. They might not be on our radar, so to speak, because they're outside of the regulated sector. That I would say is a main
Yeah.
risk.
Great. Look, and I think if you go back 10 years or so, we've probably talked to prospects and customers who were mainly, I think, almost exclusively banks in the traditional sense. These days, we've got a lot more shadow banks, and if I look at the prospect list, a lot more, 10, 20% of who we talk to. So I think they're becoming more aware. They're talking to us and others about what does this mean to them and what do they have to put in place. So I get those stats. Okay, good. Right. What about traditional banks? Traditional finance banks. What does it mean to their risk management processes? Is it affecting them? Do they have to think differently about this now?
I first to your first question, I would say yes. I think even if one wasn't dealing directly as a counterparty with a FI, a financial institution that's in the shadow banking sector, if one or two of one's large size counterparties are, it may still affect you. But if you are dealing with them directly, then of course it will impact you. So the
Yeah.
short answer to your first question is yes. Your second question, I would suggest that the risk management framework of any banking institution needs to include within its ambit, its remit, What are our exposures to this sector? Do we understand them? What might a failure of one or more firms in this sector mean for us? Now, this talk is called Liquidity Talks, and the title was How Does Shadow Banking Impact Liquidity Risk Management? Liquidity risk, of course, is amongst a whole series of very important risk types for a bank to manage, the most important, because it can literally kill one overnight if one gets it wrong. So in terms of the impact on risk management practice at a bank, a regulator, a traditional banking entity, the process should be, okay, what's our exposure to this sector? Do we understand the behaviors of cash flows in and out of this sector? How might a
Yeah.
failure or a stress event in this sector impact our liquidity risk position? Do we have sufficient liquidity reserves, instant access liquidity reserves, cash if you like, that could
Yeah.
address what a stress event in the shadow banking sector might mean for us? So the risk management processes in such banks need to incorporate this additional assessment, because again, if one might not be directly dealing with them, but if there's a market-wide impact or stress event in the shadow banking sector, it could still have a knock-on effect on you, even though you don't deal directly with them. Naturally, if one is dealing directly with them, and we know, I mean, we've just mentioned Visa and MasterCard, I mean, every bank deals with at least one of them, if not both. So we know that there is a lot of interconnectivity between the banking sector and the shadow banking sector. So at the individual bank level, one's got to include exposure to the sector in one's liquidity stress test scenarios, and that's not that's not actually. It's that, to me, I don't think that's an intellectual challenge. It's just a process
Yeah.
challenge. So let's measure and identify what our exposure is here, and then scenario plan for a stress event in that sector across one or more firms, and see what that means for our balance sheet. We should then look to quantify that, so we can then determine
Yeah.
if our balance sheet provisioning, our liquidity reserves, is sufficient to meet this hypothetical scenario.
Got it. And Moorad, you sit on boards of banks. Do you see this creeping onto the agenda? It's becoming more important. It's something you talk about.
Well, I mean, yeah, I mean, I sit on some very small firms, but the boards of small firms. But um, the short answer to your question again is yes. What is our take intraday liquidity, something that is, I know, dear to Planic's heart, but take intraday liquidity and liquidity as a whole. Let's say immediate short-term liquidity risks, 3, 5, 7 days. Let's not forget that the outflow we saw last year with those West Coast-based banks was very
Yeah.
large size in a very short period of time. So what's the immediate impact on us, whether it's intraday or over a 3, 5, 7 day period of a stress event in the shadow banking sector? What does that mean for us? I do think at the ALCO level, Asset Liability Committee, at the ALCO level, this has to be on the radar. We've got to include it in our regular stress testing, so that we have some idea, the quantification. Well, we have some idea of what our exposure is to the sector, then we can mitigate it accordingly.
Got it. And so let's talk about exposure. So, in your experience, how do banks, traditional banks, monitor and manage the exposure to these shadow banks? Obviously, this is, in the last 10 years, I'm sure there's more process, but how do they approach this? How do they monitor, manage, and assess this risk?
If I'm speaking very briefly, in summary, the process itself needn't be any different to what is currently being conducted. So when one is managing liquidity risk for a bank, for a banking institution, the main thing is understanding customer behavior. Well, no, actually, let's take one step back. The main thing is understanding the structure of the funding side, the liability side of your balance sheet. If I've got if I've got no concentration in the funding source, so I've got different types of funding, different products that provide my deposits and my funding base, different customer types. So I've got no concentration in the funding base, something, by the way, that Silicon Valley Bank and First Republic did suffer from, or what the PRA
Yeah.
calls Pillar 2 liquidity, lots of concentration in their funding base. But if I don't have concentration, that's the first thing. Understanding the funding structure of my balance sheet, it's longevity. I mean, if I've got lots of term funding on the balance sheet, I can relax a bit more. If I'm funded in a majority by contractually instant access deposits, I need to be aware of this. So that's the main thing: understand my concentration and the diversification, the diversity of my funding base. Secondly, understand at the individual customer level their behaviors. Understand the behavior of a large corporate, a small corporate, an individual customer, if there's a stress event impacting me. This is standard stress testing technique, by the way. So this is what we would do. We would make sure we had a a viable, a robust funding structure, and then we will look to understand behaviors of all the different funding products and the behaviors of customers in a stress event. If we understand that, we'll get an idea of what our risk exposures are, and then we monitor accordingly. Your question was, how do we monitor that? Well, we keep an
Yeah.
eye on deposit balances, both at the sum level and at the granular level by customer and product type. We keep an eye on that. We forecast it, and then we back test against our forecasting to see that our understanding of where it's going to go is accurate, and then adjust
Yeah.
parameters and assumptions accordingly. And then we keep an eye, and we have risk limits to make sure we stay within our exposures. We stay within limit. I mentioned concentration. You might say, for example, no more than X% to this type of customer, or no more than
Yeah.
Y% of funding from this type of product. So we monitor accordingly. Now, your question was, what should we be doing for the shadow banking sector? In theory, at least, and I'm sure pretty much in practice, it doesn't need, that process doesn't alter for the shadow banking sector. It's about
Yeah.
understanding customer behavior, understanding our exposure, if we're getting funding from that source, understanding the behavior of that, if we're lending to that source or providing payment services for that source, understanding what that means for my liquidity risk exposure, understanding how their behaviors might impact my balance sheet for liquidity risk. It's about knowing your customer. So that monitoring process and management doesn't change. It's just about making sure I'm aware of it for the shadow banking sector of my business, as well as the regulated sector or my customer sector. I've seen a comment on the chat about regulatory oversight, and it's a data challenge. It is, yes, it is a data challenge. I mean, you could ultimately say all balance sheet risk management in banking is a data challenge, but it's a data challenge to understand. I mentioned about understanding behaviors. It's a data challenge to understand behaviors, to be able to model behaviors, to forecast behaviors, and to stress test behaviors as well. That's a data challenge as well. And I've just seen another comment there about big tech as super monsters taking over bank risk and fragmenting traditional banking.
Indeed.
I know that's possibly possibly a more sort of Armageddon type scenario.
Futuristic.
Yeah, yes, futuristic. I think this is the regulators around the world, regulatory authorities around the world, I am sure have this on their radar. And the question is going to be, okay, should some of these institutions, not all of them, some of these institutions be brought under more formal regulation in the way that a bank is? Well, that's the question of the day, isn't it?
No, it is.
I'm not sure I want to opine on that at the moment, because regulation in itself isn't a panacea. Credit Suisse was as heavily regulated as any bank has ever been in history, because it was a G-SIFI bank, a global systemically important bank. It was as heavily regulated as any bank has ever been in history, and it still managed to become unviable. I'm not necessarily sure that increasing safety necessarily means increasing regulation, but it does mean increasing our own sensible practice at the individual bank level. I mentioned the role of the ALCO in managing this.
Yeah,
The
absolutely.
ALCO of every bank has got to be on top of this at its individual bank level. If every bank's balance sheet around the world, every bank in the world's balance sheet was managed by a sensible ALCO that understood its balance sheet risk and had sufficient senior executive authority to be able to genuinely own the balance sheet and ensure its viability, then actually we could afford to have a little less regulation, because banks would be very well managed at the individual level. So I think that's the challenge at the individual bank level. That's where the challenge is.
And what I'm implying from this, Moorad, is if you're a shadow bank, you may not get regulated in the same way. But if you behave like you are and you put the various processes and risk management frameworks in place, you'll be in a far better place, because regulation is a series of checks to make sure you comply, but behave in the right way, have the right processes in place, and you'll be in good shape.
Absolutely spot on, Mr. Roberts. I don't think I could have articulated that better than myself. That's spot on, because if I'm whatever entity I'm involved in managing the balance sheet for, whether it's a payments institution, a deposit, a deposit gathering institution, or a lending institution, or a combination of those, or a wire transfer mechanism, or anything like whatever business the entity is involved in, if I am managing its balance sheet exposures in a sensible way, so I understand the balance sheet exposure, the risks, and I'm able to manage and mitigate them properly at the individual bank level. If everyone is doing that in a sound way, there's a lot less risk in the system as a whole. Whether that means getting on top of your risk appetite framework, getting the risk limits in place that are appropriate to your business model, getting in place the data analytics that we spoke of, or a combination of all three, whatever is required, if we can get on top of all that at the individual firm level, then at the systemic level, risk is much reduced. It's a much safer system if we get the individual bank level processes as robust as they can be.
Got it. Okay, so and I see a question here from Daniel, he says it's all about visibility, and it links on to my next questions. I think that's an output from it. But it's what role does technology play in enhancing risk management practices? I guess that's a general question I have, but specific to this, because it's about data, it's visibility, analytics, it's all of those things, right?
It is. I mean, your question was what role does technology play? It plays a very large role. I remember reading a survey. This is when I was applying as for graduate trainee roles in banks when I was still in university. I remember reading a survey in The Economist about the banking sector. And even then, this is back in 1989, even then it referred to banks as large IT companies that do finance. And if that was true in
Yeah,
1989, gosh, boy, is it true in 2024. The technology is very important because I mentioned knowing my balance sheet risk at the individual bank level, at the ALCO level. To know my balance sheet risk, to know my exposure, to be able to understand what the impact on the balance sheet, capital and liquidity, what the impact on the balance sheet would be through external factor changes, factors that are outside of my control, interest rates, geopolitical events, etc. To know that exposure and sensitivity requires data in front of me. I require a dashboard of risk exposures telling me what my current exposure is, and ideally telling me what the exposure is going to be in the near future, and then even more ideally telling me what the position of the balance sheet will be, capital and liquidity position, if such and such happens in the future. If I've got all that to hand, I'm in a much better position to make decisions that ensure balance sheet viability. So it is really about technology and
yeah,
data analytics together with good governance, with good
yeah,
risk
yeah.
culture. The question
You
in
need
the
that as
chat was
well.
about visibility, and there was another question in the chat about visibility and openness across the parts of the sector. I mean, I'm all in
Yeah,
favour of that. I love the idea of knowledge transfer and openness in everything. I'm a big fan of that. But firms are corporate entities, have their own cultures, they have their own proprietary information they want to keep secret,
yeah.
etc. They have their own confidentiality rules. So that would be a big challenge. But I'm all in favour of openness and knowledge transfer. I've always been in favour of that.
Yeah, I mean, obviously, we hear banks say to us a lot. I need to control my liquidity. I need to manage it, optimize it, use it in the right way. But if you strip that back, what they're really asking is, I bring data into the bank. I need to get that into the right form. I need to be able to access that as real time, if not real time, as real time as I possibly can, and turn it into the right actionable insight, so I can do things. Whether it's liquidity, it's risk, it's operations, it's across the board. And if you do that right, you'll be in a great place.
You're quite right. You've basically described an ideal situation, an ideal scenario. I think there's a difference between nice to have and essential, and I think
Correct.
one or two of the things, if not more, that were previously in the nice to have bucket are now in the essential bucket, and because accessibility of technology related solutions is now much greater than it was, say, 10 or 15 years ago. Even small firms small financial institutions can make use of what's available today. They can set in place a technology solution that suits them, that improves their balance sheet management capability.
Yeah.
So I think there's less excuse for small. I mean, there's no excuse for large, I would suggest, but there's less excuse for smaller firms to put in place very good technology solutions and real-time data analytics such that they are aware of their balance sheet exposures and positions at all times, and in a real-time basis, ideally in a real-time basis. So it's just more accessible nowadays. I mean, AI is all the rage as well. Machine learning
Yeah.
models, to use as part of
Mm.
your, whether it's your, I mean, I mentioned credit risk. I mean, we're talking about liquidity risk, but whether it's liquidity risk or credit risk, there is much greater accessibility of solutions using good technology than there would have been 10, 15, 20 years ago. So it's not as if a machine learning system to help manage your liquidity risk or your credit
Yeah.
risk is now beyond any but the largest firms. It's possible to implement those at much smaller firms, startup firms, new
Yeah.
banks, challenger banks, as well as fintechs. So that's all this capability that might have been in the nice to have bucket a few years ago, I think is now more and more in the essentials bucket.
Got it. And Moorad, here's a nice juicy one for you from Dan Feeney. If you want to plead the fifth for this, and you can, but it's the last question in the comments section, because you might have to. Very, very on moment here. Any comment on the new U.S. administration rolling back Dodd-Frank haven't we learned from 2008? If you want to, if you can't
I was,
answer that, that's okay.
I mean, yeah, you know what? I genuinely, I'm not pleading the fifth. I genuinely need to think about that one before I prefer an opinion. So you'd need to leave me longer to think about that one. So forgive me. The solution to bank failures isn't necessarily always yet more regulation. In 2008, clearly it was. One could say that after US bank failures in the early 1980s, in the savings and loan, they maybe should have looked at regulation there. One could say after Silicon Valley Bank, maybe Basel III guidance should be implemented at smaller banks in the US as well as larger. I know that's a very topical debate in the US right now, especially with Basel 3.1. I'm not sure necessarily that yet more regulation is always the most effective response to the latest bank crash. At the same time, unwinding some aspects of Dodd-Frank may or may not have a negative impact on systemic safety, but I genuinely would need to think about that a bit more before I can prefer an opinion.
No, I get it. Very, very politically well said. And I think sometimes it's not just about more regulation. It's about implementing the regulations that are there, right, and making sure that they're right and they're fit for purpose.
Spot on, Neville. It's risk culture. It's risk culture. If you read the risk management policies of a failed bank in 2023, they would have all said the right things. They're required to by regulation, and yet they weren't implementing. It's implementing them. It's not, to me, good risk culture. And actually, if you're gonna love this. It's actually in the book. Anthology. It's in the book. I didn't want to plug it so explicitly, but it's in the book. I have a section afterward. I have a section about. It's good risk culture in any institution, whether it's a shadow bank or a traditional bank, is actually doing what you say you do in your risk frameworks. So if you have risk limits, stick to them. If you say we do X, Y, and Z for good practice and good customer service and good counterparty service, then actually do them. If you have poor risk culture, which I suspect is what was the main failure at Credit Suisse, then it doesn't matter how heavily regulated you are or how in depth your risk policies are, you're going to fall foul of them if things go wrong at the right time. So it's not just about regulation and rules, it's also about good risk culture, doing the right thing so that when you say we're going to manage properly, you actually do manage properly.
Got it. Right. Last question, because we are running out of time. Apart from buy my book, what's the one takeaway bit of advice that you would offer to the viewers today, if you could just say one?
Actually, may I go to the risk culture point? I would say whatever one's role in a bank or a non-bank, in a non-bank FI, whatever one's role, we're all risk managers. It's not just, it's the CRO's office, the chief risk. It's not just the second line of defense or the chief risk officer that is responsible for managing risk. We're all risk managers. If we all do the right thing, we adhere to the right risk culture, we have a shared common goal about maintaining balance sheet viability, to above all else. And of course, viability includes P&L. I don't just want lots of capital and liquidity. I need to make profit. Otherwise, I'm no longer viable. If we have as our overriding goal maintaining balance sheet viability, and have the culture that we're all risk managers, so we're always doing the right thing for the firm as a whole, then I think the system, at systemic level, we'll all be in a safer place. I would suggest that. Look at one's risk culture and adopt a view that we're all risk managers. It's not just the role of the second line defense. So that's probably what I'd say if you're giving me just one solution.
You can only have one. And look, there's some more comments coming in. I just noted that you have been discussing prudential regulations of shadow banking, so that's interesting as well. But we're not only running out of time, we have run out of time. There's one more thing you want to say?
Well, I was going to say I'm not necessarily certain that we need to bring the entire shadow banking sector into the same prudential regulatory framework that banks are, and I'm sure that regulators are looking at exposure in the shadow banking sector. I would still say the real solution is in having very good risk practice, risk culture at every firm, at the individual bank level. That's what makes the system safer. If your ALCO is managing the balance sheet properly, whatever firm you are, if the ALCO is on top of the balance sheet with a long-term view in mind, the system as a whole, the industry as a whole will be safer.
Perfect. Well, look, great talking to you today, Moorad. We have run out of time, so thanks for joining us, sharing your views. If anyone has any more questions or comments, offer any more comments, we will endeavour to answer them after and send them back to you. So that concludes our latest Liquidity Talks live stream and podcast. We'll put the podcast on LinkedIn, Spotify, Apple Music, and other media outlets and streaming services very soon. Thank you very much, everyone, for joining today. It's been a fantastic podcast. Look out for our next podcast coming next month. My name is Neville Roberts. Thank you for tuning in, and goodbye.
You've been listening to Liquidity Talks. Don't forget to subscribe to stay updated on the latest developments and industry opinion from the world of treasury, liquidity and risk.